Sorry. And so what is income? For tax purposes, it is the gross income. It is all income received in the form of money, goods, property, and services that is not exempt from tax. It includes income from sources outside of the U.S. or from the sale of a primary resident, excuse me, even if part or all of that income can be excluded. Gross income may include part of Social Security benefits received in certain scholarship and fellowship grants on here. So when we say goods, property, and services, so some people may barter. Hey, if I do maybe your tax preparation, then maybe you could provide me with some IT services. So how would we distinguish that and put that on the tax return? What is the fair market value? But what do you charge per hour to prepare a tax return? What does that person charge per hour to maybe do IT services, maybe for a website? So that would still be considered income and be reported on the tax return. And then you'll see it is even from sources outside of the U.S. So if you're working overseas, on there have rental property overseas, on there you will still have to report that on your tax return. I know at North Dallas we do have a few individuals that are, they were born in Canada. Or they've maybe come from another country over to the U.S. and now they're living here and they're getting foreign income from like a foreign pension. So what do we have to do? Typically, they have it all set up for us is they will find the exchange rate of that income as of December 31st. And so that's how we report it on the tax return on there. And so you see gross income may include part of Social Security benefits received in certain scholarship and fellowships. So if a person, their only income is Social Security benefits and they don't have, they're not married filing separately, then in most instances that Social Security income, they're not required to file a tax return. You'll also see below where we have the certain scholarship and fellowship grants. Well, you all typically at the end of the year, you may receive a 1098-T. And in box 1, it's going to show the tuition expenses that were reported to the university, as well as in box 5, it's going to show scholarship and grants. Well, if those scholarship and grants in box 5 exceed box 1, and you're not able to offset those against any other books or supplies that you had to purchase, it's possible that excess scholarship and grant you're going to have to report as income on the tax return on there. Okay, so when we go and talk about income, income that is taxable, we have some taxable income and we have non-taxable. So the taxable income must be reported on the taxpayer's return and it is subject to tax. It could also be subject to other types of tax. When we talk about those sole proprietors, those contract workers, they have to pay their federal tax, but then they also have their self-employment tax. Income that is non-taxable, it may be shown on a taxpayer's return, but is exempt from tax. So there is some like some U.S. saving bonds that come on a interest, a 1099 INT form on there. It could be shown on the form 1040, but not included as taxable income. You also see maybe a person has pension or 401k where they contributed themselves. Maybe they've already paid tax on it. Also, like a Roth IRA, it's listed on the tax return on there, but it is not reported when you go and add up your total income because you've already paid tax on that. So then if we go to 4012, page D1, we're going to look at some examples of taxable income. So I've highlighted some of the forms of income that we see that come through our VITA sites. The first one and the most common one is our wages, salaries, bonus, and commissions, and that's going to be reflected on a W-2. You will also see awards. So this could be reflected on a W-2. This could be on a 1099 miscellaneous statement. It just depends where it's coming from. It also could be on a 1099 interest statement on there. Maybe if you got a incentive for opening up a bank account. or maybe you were in a competition or something and you won some rewards, or if it was something through your job and it was rewards. We have our business income and self-employment income. Again, that's our sole proprietors, our contractors. That's the same for the cash income. Compensation as well for personal services. Then we have canceled debts on there. So there are some canceled debt for us, maybe if you purchased a vehicle and you could no longer afford to pay for it, and the company that you were paying your car loan through, they came to repossess it. And so then after a couple of years, you get a statement, a 1099-C form. That means you were personally liable for it, for that debt, and so they cancel it. So what they took care of, maybe they had to resell it, and they had to resell it at a smaller loan value than what you still owed on it. So then you're going to have to report that canceled debt on your tax return. There may be ways that you would probably be able to exclude most of it. Then we have disability benefits. This could be, like I said, employer funded. Maybe you got hurt on your job, you can no longer work. But disability benefits, they're still going to be classified and treated as W-2 income. They also could be on a 1099-R. That's a retirement pension form, but there's going to be a code W in that box 7. There's dividends. So this could be, maybe you have a brokerage account and you have some stocks, bonds, or mutual funds on there. And so instead of you deciding to receive the income, you maybe want those dividends reinvested. You want it so you can purchase more stock or mutual funds. So whatever the dividends that you earned for that year, that's going to be on a 1099 DIV. Again, employer awards, employee awards, employee bonuses. More than likely, it's going to be reflected on a W-2. Gambling winnings. We're right next to Oklahoma and Louisiana. So we have a lot of people that go into those casinos, and we have some people that win. Now, I don't know how much they lose, but they do bring in their winnings. We also have their interest. Again, this is putting your money in a savings account, a CD. Or again, if you're opening up an account with the bank, you could get a 1099 INT form. We have our IRA distributions, like our retirement accounts, military pay. They get a W-2. There's the military pension on the 1099-R. The non-employee compensation, that's the 1099 NEC. Again, those are those self-employed sole proprietors. We have those pensions, prizes. So all of these different game shows where people, they win maybe a trip, maybe a car or a boat or something. They don't tell you maybe at the beginning or the end of the show, once you win, they're going to ask you for your name and your social, your identification information. Again, it goes back to rewards, royalties. Royalties could be maybe, I know for Louisiana, and I've also seen it kind of like in Tarrant County, if a company is going on your property to get some of the natural resources. Severance pay, so you're leaving a job or a job is letting you go, maybe based upon your contract agreement, or they're going to maybe pay you out for a time frame. That's also going to be reflected on a W-2. Self-employment income, Social Security benefits, which a portion we're going to see of that may be taxable. Supplemental unemployment benefits, taxable scholarship and grants, tips and gratuities, and again, unemployment compensation. So these are some of the common forms of taxable income that we see, and we're actually going to go through some of those forms that they are listed on, tax forms. Now we have some examples of non-taxable income. So if a person comes and tell you that this is what they receive, you can let them know that it's not taxable. It is not reflected on the tax return. So child support, the person that has to pay it or the person that receives it, it's not reflected on either one of their tax returns. It still has the economic impact payment. If you're doing prior years, that's not reflected on the tax return. Employer reimbursement for ordinary or necessary actual expenses. If they have what is called an accountable plan, if you turn in your receipts and they reimburse you for what's listed on your receipts, that is not income on there. Federal income tax refunds. So you're doing someone's 2022 taxes and they have a refund. They do not have to report that refund as income for the next year. Also, gifts that you receive, monetary gifts, vehicle gifts, you do not have to pay tax on it. They'll talk about gift tax, but those are for those individuals, those wealthy individuals where they're having to pay their gift tax, the gift tax. And that's the person, again, that is giving it. Inheritance or bequest. So when we talk about inheritance, something that you're receiving from a person's estate, those are non-taxable with the exception of if you inherit or if you become the beneficiary of a person's retirement policy. If you're the beneficiary of a 401k, any type of pre-tax plan, you do have to report that as tax on there because the person who had it, they were not paying taxes. Insurance proceeds, that's not taxable. Interest on the EEI bonds that are used for higher education expenses, payments in lieu of workers' compensation. There's the qualified Medicaid waiver payments, rental less than 15 days. So say I rented my house out and I did make money, whatever the value was, but again, I rented it for, again, it says less than the 15 days, regardless if I made $15,000, $20,000, I don't have to report that as income. Sickness and injury payments. Some of the Social Security benefits, a portion may not be taxable. SSI and TANF, that's not taxable, doesn't go anywhere on the tax return, as well as workers' compensation and similar payments on here. So if you see someone, they tell you that these are the type of payments that they receive, we don't have to reflect this on the tax return. So the most common form we have is the W-2. So these are for our employees on here that they're going to receive this. And again, it reflects their wages, tips, compensation, as well as their bonus or prize awards that they receive. So an employer, they are required to get this to the employer, have this sent out by January 31st. And they also send a copy of this over to the Social Security Administration Office. And once they put it in their system, it gets reflected over to the IRS on there. So this is going to be one of the most common forms of that you're going to see coming through the office, the W-2. You're going to see in box A, it does have the employee social on there. Again, you do not take input this employee social from the W-2. You go from the Social Security card or the I-10 letter or card. It's going to have the employer identification number. Most of the time now we are seeing that these are truncated, where we may have the last 4 digits of the employer EIN number. But in order for us to file it electronically, we will need to have the entire EIN. So it's definitely useful if we have a past client and they still worked at the same employer. Also, we have the employees, their first and last name. So sometimes we just want to double check the social, make sure it matches as well as the name, because sometimes we have seen people come in and they'll bring their W-2s in the envelope. They've never opened up the envelope. And, you know, this entire time they thought it was their W-2, and for whatever reason there was a mix match, and maybe they have their coworker's W-2. And so now they have to go and get get the actual copy. And then they're going to have their wages, their federal withholdings, all of this information corrected. So all your job is to do is take the information on the form and input it into TaxSlayer. And the good thing about TaxSlayer is once you start and put in their wages for box number 1, it's also going to put it in box number 3 and 5 on there, and it's going to calculate the Social Security tax withheld and the Medicare tax withheld. So all you have to do is review it and make the changes if actually boxes 1, 3, and 5 are different. So again, everything that you see on this form, you're going to input it into TaxSlayer on there. Texas, we're not subject to federal taxes, federal state taxes. So most of the time, if someone is a resident of Texas, you will not see the bottom part filled out unless maybe they moved during the year. Then you could see another state listed there, and you can input that information in. So where do you enter this information, the W-2 information, into TaxSlayer? So we talked about starting a tax return after you've entered in their social on there. Then TaxSlayer is going to, after you enter in the taxpayer's social, TaxSlayer will then prompt you to select the filing status. And after you select the filing status, it's going to have you to enter in the taxpayer and or spouse basic information. And then if there are any dependents information. Then it's going to ask if there is a identity theft pin, and then it's going to then take you to the federal section. And then under the federal section, you see income is listed first on there. And you're going to see down in the middle, there's all different types of sources of income, which at the very top, you see the form W-2. And then to the right of that, you're going to select begin. Begin so that you can enter information into the W-2. And when you click begin, you're going to get this blank screen that's going to populate on here. Go to the next one. And it's going to have different boxes that you can select. So most of the time you're going to see at the top left, it's already going to be selected standard W-2. There are some times where it may be a corrected W-2. Maybe their wages or withholdings was incorrect and they needed to have it updated. So that means the first W-2 was already submitted to the Social Security Administration, and then they're going to have to submit a corrected one. Or you may see a substitute W-2. That means those are those individuals that maybe their company has closed down and they're unable to retrieve their actual W-2 form. And with those type of returns, those have to be paper returns. And we will not do the substitute W-2s until late February. So they have to make attempts to reach out to their employer, maybe try to get a transcript or some way where they can get that information, unless we know for sure that that company has closed down. So you're going to see who does the W-2 belong to. You'll be selecting the taxpayer, or if it is a married filing joint, the spouse. And you're going to input again everything from that W-2 into TaxSlayer. Also at the bottom left, you're going to see that it may populate this I-10 social. So if we started this return with an I-10 number, that W-2 is going to have an open space where we can actually put what is the social that they're actually using on that W-2 form. And so the IRS, as we're putting all this information in and we transmit it, the IRS is mapping all of this information for us. So again, take what you have on the W-2 and input it into the system. Okay, on the next screen, so it's just showing you where you're going to input those wages. On there, again, when you first input those wages and you tab over out of box 1, it's also going to put that and bring down that wage information into box 3 and box 5. And box 4 and 6 will already be calculated for the tax. So you'll just verify that information, make any changes if necessary, and then also don't forget the federal taxes withheld. So we're still mimicking what we have on the W-2 form that we received. On there, as you input all this information, TaxSlayer is doing these calculations. They're telling us if this person qualifies for earned income credit, the child tax credit, the retirement credit, so it's running these calculations on here. but we will not tell a taxpayer what their refund or amount due is until we enter in all their information and review their tax return. So you'll see in box 13, you'll see that middle box, it has retirement on there. And so by us selecting retirement, it can calculate if this person if they qualify for the retirement credit. Also with box 12, there's different codes that they can put in. And again, it's going to determine if they qualify. So there's a couple of different codes. Think D, A, G determines if a person actually puts some money into their retirement plan. It'll also show if they had insurance. A code DD will show possibly it could be medical, dental, or vision insurance on there. And then code 14, it could be other. So there are some places, I believe maybe UT Southwestern, where there is a code, individuals have retirement, and we have to go and pull for under 14, the drop down is the TRS, and so it'll pull in the retirement form. So again, with all these forms that you receive, whatever you see on the form, enter it into TaxSlayer. So I wanted to pinpoint on here, this is on this screen, it has less common income, but I have other compensation highlighted because I wanted to bring to your attention, we talked about the taxable scholarship and grants. There is some other compensation, which is scholarship and grants, that could be treated just like W-2 income. So on that 1098T, we talked about when box 5, the scholarship and grants, is more than box 1. And there is no additional books or supplies purchases that will help offset or reduce that excess scholarship or grant. So where do we go and put that information in TaxSlayer? So you saw in the federal section where it has the income, you're going to see where it has less common income. When you click on less common income, you're going to click on other compensation. And when you click begin on other compensation, it's going to take you under other compensation. It's going to take you to where you're going to see at the top scholarship and grants. And when you click on begin for scholarship and grants, you're going to put that excess amount in there, and it's going to convert it over to the 1040 just like a W-2 income. And then on that line, it's going to put scholarship and grants listed on there. And so the good thing about the scholarship and grants, this possibly could qualify a person for maybe earned income credit if they are doing their return as an independent. So our next form that we have, it is our 1099 INT. So this is the interest form. On here, somebody could receive it similar to this, but what we're looking for is we're looking for that 1099 INT that is letting us know the type of form it is. And when we get to TaxSlayer, where do we input that information? It is the interest income. So again, we take all the information from this form and we input it into TaxSlayer. So for financial institutions, if a person has received $10 or more for the year, the financial institution is required to send out a 1099 INT on there. So you'll see most individuals, they probably get this maybe from their brokerage account, maybe if they received a prize or reward for opening up an account. So with this one, you'll see in box 1, it has just the regular interest income. So that's the just interest earned from putting money in there. Or again, it could be the money that they receive for opening up the account. Box 2 is the early withdrawal penalty. So this is actually, we're going to talk about it when we talk about adjustments, but it's listed on this form. And when you input it on the income side, it already takes care of it on the adjustment side for us. So this could be a person with a CD. And with a CD, you're supposed to let it sit, let it mature for a certain period of time. If you decide to withdraw those funds before the maturity date, that means you are forfeiting some of the interest, which there's a penalty, and it's going to go in box 2. And that means you're going to have an adjustment on your tax return. You also may see box 3, interest on U.S. savings bonds or treasury obligations. Very rarely do you see anything in box 4 on federal taxes withheld. If you do, most of the time it's because maybe a person did not put in the correct social to verify themselves, or it could be an I-10 holder, which makes them subject to the federal withholding. It could be also amount in box 6 where it has foreign tax paid. And then we go to box 8 where it says tax exempt interest. So we talked about that taxable and the non-taxable income. This tax exempt interest in box 8 is going to be reflected on the tax return, but you're not going to have to include it in your total income that you're going to pay tax on. Okay, so the same thing for the interest income. Those should be to the taxpayer by January 31st. And again, an individual will only receive this form if their interest is $10 or more. Now, just because individuals, they're not receiving a form does not mean that they don't have to report it on their tax return. So all income received, it is taxable unless the IRS states that it is exempt from tax. So we're going to be going in later when we talk about maybe a person received cash income, or not receiving a form does not exclude you from not putting it on your tax return. So where do we go and put the INT, the interest income? Again, when we saw on that federal side with the income, we're going to search for interest in dividends. And when we click on interest in dividends, you're going to see down that box at the bottom. It's going to have those 4 options: interest income, Form 1099 INT, the original issue discount, that 1099 OID, the 1099 DIV, dividend income, or seller finance interest. So you select your interest income box. And again, you're going to input that information. So you're just duplicating what's on the form and putting it into TaxSlayer. And so the thing about the interest income, there will be asterisks. So I think there's only requirement for the payer's name, so the financial institution name, as well as then completing the boxes. So you don't have to put in the EIN number or putting in their address. So again, we're just taking all of that information from the form and inputting it into TaxSlayer. Okay, and then we have our 1099 DIV. Again, so we talked about these could be the mutual fund or a stock that you have in a company, and the earnings, they're considered dividends, not interest on there. So you could have the option that you're going to receive those as cash payments, or you're going to reinvest them back into the company. So your dividend form, it could look similar to this, or it could be just a consolidated form, but as long as you see 1099 DIV or it has dividends and distributions, you know that it is where to input this into TaxSlayer. And again, the same thing, you're the institution. The goal is to get it out by January the 1st. Now, I do know that some brokerage companies, sometimes they don't have things available and ready until the month of March on there. And so you could probably get all of this information. It could be like if you have a Robinhood account, like even these self-directed ones. So like Robinhood, if you're doing your investments yourself, you'll be getting these forms. So we saw where we entered the interest income. And so we saw where there was also the button on there where we will input the dividend. And we click on the dividend. Again, we're going to input everything that we see on the dividend form and input it into TaxSlayer. So there's nothing special or new that you're doing. You're just knowing this is the form that I have, and this is where I'm inputting it into TaxSlayer. And TaxSlayer is calculating everything for us. The only thing is we come back and review and make sure that it go into the right area, where all the buttons where they checked on there. Or, there's sometimes that there's maybe like a computer glitch where maybe if I'm reviewing your tax return and I see maybe a person did not receive a credit, or typically they were probably entitled to. So then I'll go back and as I'm looking through the return, did we miss something? Or is TaxSlayer, are they doing an update or something? Okay, so we're at a poll question right now. So we've talked about so far W-2, interest income, and dividend income. So you may have to go back to click to your intake form, that 13614C, or you could go into the irs.gov website and type in the 13614C. But where on the intake form is the W-2, interest form, and dividend form? What section is that reported on the intake? Is that part 1, part 2, part 3, part 4, or part 5? So you can either go back to the housekeeping part on your slides, or you can also go to the irs.gov and type in the form 13614C. So I'll give you guys a little bit to kind of look and find where that section is. Say it again.
3.
It is part 3. So part 3 is all the income on there. That's the income section. Okay, so this is the biggest topic. So this actually, our business income. This became popular and blew up, I would say, in 2020 during COVID, when a lot of people, individuals, they lost their job. They were the Uber, Lyft, DoorDash, a lot of those industries, they actually started increasing. People found ways, started utilizing those services. Definitely with restaurants closing, they were doing a lot of delivery service. So, under business income, taxpayers are self-employed if they carry on an unincorporated trade or business as a sole proprietor or independent contractor. So this means that you're not having to go to the Texas Secretary of State to fill out paperwork. Some people probably don't even go to their county, Dallas County, Kaufman County, probably to even do their paperwork. But this is maybe like a trade that they have, and they're actually providing a service or providing a product to be paid for it. These taxpayers may not have income statements for their business income and expenses. The information to prepare their tax return comes from their records. So some people may use a QuickBooks. Some people probably maybe keep like notepads, have receipts, different things on here. So these could be our landscapers, hairdressers, babysitters. It could be actually professional service like an accountant, person providing IT services. Any of these could be within those, this trade or business, a sole proprietor or independent contractor, and meaning they have business income. So we're going to go look through some forms that we may see that a person with business income, what they may come in with. And the first one is the 1099 NEC. So this is the non-employee compensation form. So they started using this form back in 2020. So if a person comes in with a 1099 miscellaneous amount in box 7, it means the same thing as this form right here. So it's going to have where they work, the payer's name. It could have the payer's TIN, taxpayer identification number. That could be an EIN, or it could be a social. Then it's going to have the recipients, EIN or social. number or ITIN listed on there. And so have the taxpayer's information, and it could have their name. It could also have maybe the taxpayer, they have a DBA or business name listed on there, that it would come on this form. And then we have the non-employee compensation. So the payer is required to get this out to certain individuals, organizations, if they pay them $600 or more for the tax year. So say, for example, someone received $400, and so I had to issue out them $400, and they did some work for me. They were a contract worker. I'm not required to give them a 1099 NEC. But just because I did not give them the form, they are still required to report that $400 on their tax return. And so they could have that if I gave them a check, they could still have that through when they cashed it. They could have the receipt for where they cashed it. If they took it to their bank, they could have that receipt or use their bank statements on there. So they are required, the payer is required to send these forms out if they paid that individual $600 or more for the year, and they still have the requirement of getting it out by January the 31st on there. Very rarely will you see anything with the federal income tax withheld. But typically it's just number one, the non-employee compensation box on there. Okay, some other business income forms. It could be a W-2. Going back to the W-2, it could be the, on box 13, highlighted in yellow, the statutory employee. That is the only indicator that this would be business income. Everything else would mean it's just an employee. So this is more of insurance and salespeople for number 13, where they would be able to write off their expenses. But that is very rare that we're gonna see at our tax sites. Okay, another form that we have, it is the 1099-K. So this is a form where a person receives credit card payments. Now, so for 2022 tax year, there was a legislation where individuals that had $600 or more in credit card sales, they would be getting this. So that was going to be your Cash App, your PayPal, all of these payment processors that a lot of people would be getting this. I think maybe the Venmo, they were supposed to start an act where this would be the tax year where we would get all of those forms, that anyone $600 or more would receive it. But there was pushback from the financial institutions that it would be too much information, too many forms that would have to go out with that threshold being dropped significantly on there. So I think it's back at, maybe it's either 5 or 20,000 or something where they're required to send these out on there. So you're going to see these from like our Uber or Lyft individuals. Maybe if someone is doing sales using PayPal, they possibly would receive this form. And what we're focused on is box 1 when we entered into TaxSlayer. We're box 1A, the gross amount that they receive. That's what we will be putting in the tax system, because everything else is just a breakdown of what they received monthly or the number of transactions. And so the payee will be receiving this January the 31st to file on their tax return. So we would input this. This would be their business income that will be reported. So these are all of their credit card sales. It doesn't capture any cash or check sales. Okay, so the next form we have, this is a form that we provide at Dallas Community Tax Centers. So someone may not receive a 1099 NEC. They may not have a 1099-K or a W-2. They could just have maybe cash and check income. and they're not really up to speed with keeping business records. So what are we going to do in order for us to prepare that tax return? We're going to provide this self-employment worksheet for them to complete. So before they sit down and you prepare their return, they're going to complete this form where they get to fill out their income for the year as well as their expenses. So if we look at it, it's going to ask them for their cash checks, 1099-K, that information that they're going to put, as well as they get to put additional income that they've received. We also ask them for their industry. What is it? Is it, again, babysitting or daycare services? That way, when we get the return or we get the paperwork and we start working on it, maybe they didn't think about all the expenses. Maybe they forgot something. And so, maybe me assisting or asking additional questions, or you, if it's something that you're familiar with, you can probably draw out more expenses that they may have. And then it drops down and it's going to ask their general expenses, which could be advertising, commission and fees. Also some common maybe legal and professional services if they have a bookkeeper. If they have any office expenses or supplies, some machinery or equipment rental, repairs, additional supplies if they have to travel, or if they have any business meals. Or do they have an actual office? Other expenses could be their business phone, professional education. Because we have some realtors that frequent, that come to our site location. Protective clothing and shoes. Maybe if it's in the construction industry, they have to have the hard hat, the steel toe shoes. Maybe small tools, and then car and truck expenses. So this is their tolls and fees, as well as the number of business miles. So when they fill out this information, they're filling out just everything business related, not personal. So we don't want any personal expenses listed on this form. And so when we input this information into TaxSlayer, in addition to that form 1040, it's going to populate this Schedule C. All the information that we've asked them for their name, which we put that at the beginning, their social. If they actually have a DBA or a business, maybe they've obtained an EIN number from the IRS, that's going to go there. If they have a separate address or location for office space, it's going to go on the form. And then you're going to see it goes to their income as well as to their expenses. So it's going to provide them with a breakdown. So everything that they provided us, it's going to go and get pulled in onto this Schedule C form. And then this lets us know if they have a net profit or a net loss. This is the second page of the Schedule C. So our cost of goods sold, that is out of scope for us. So we don't work with individuals, small business, self-employed sole proprietors that have an inventory. And then it goes and asks them about their vehicle expenses. So we only do business mileage. In addition to, we can add their tolls and parking. So we do not depreciate their vehicle. So we do not do actual expenses. VITA programs only do the standard mileage. And then there's the Part 5 that has other expenses. So you see that general expenses category. If there's anything else that's not listed, maybe like postage, shipping, maybe they went to a continuing education class, we could put that stuff under other expenses. Okay, so within the VITA program, who can we assist for our business income? So with our Schedule C, they must have less than $35,000 in business expenses. We only do the cash method of accounting, so that means they're recording that income when it was received, as well as expenses when they were paid. So no accrual method of accounting or any hybrid. They cannot have any inventory at the end at any time during the year. So maybe we can convert that inventory to just being supplies if it's nothing significant. A lot of people have t-shirt businesses. So if they can keep their number of t-shirts at a minimum, maybe we can use, again, classified as supplies instead of inventory. They did not have a net loss from the business. There's a time where we may make exceptions if the net loss, if it is small. If it is something significant, I would say probably $1,000 or more, that is going to be at my site out of scope, and they would want to go to a tax professional. They will want to go to a paid preparer. And we do not recommend any paid preparer. They could just go on the irs.gov website or go to some other sources to look it up. Also, they cannot have any employees during the year and did not pay contract labor for services. That is out of scope. So no W-2 employees. If they have the contract labor for sources, is it possible for us to maybe put it in another area? Is it within a certain range? If not, we will not be able to record it as contract services, because then that means they have a requirement to send out a 1099 NEC to those individuals that they paid $600 or more. And then, again, we're not required to file the Form 4562. We're not depreciating or amortizing any of their equipment. So that could be their vehicle. It could be any other type of machinery that they have for their business on there. So their vehicle, it would be, again, we are using the mileage rate. And do not deduct expenses for the business use of a home on there. So for those home offices on there, that would be considered out of scope. Okay. So some expenses, those ordinary and necessary within scope: advertising, business cards, car magnets. Maybe they have a website. That's something that we're able to put on the tax return. Again, the car and truck expenses. So for 2022, the IRS actually broke up the standard mileage rate. And typically in most years, it's always been one set amount for the year across the board. So for January through June, it is 58.5 cents per mile. And then July through December, 62.5 cents. So typically if they were to fill out that business worksheet, most of the individuals, they just lump all of their miles for the year. And more than likely, we would just split it. So if they told us they had 12,000 business miles, then 6,000 would go to the 58.5 cents. And then 6 miles would be the 62.5 cents per mile. So they're able to do the mileage rate. And we typically like it because they're able to get more of a deduction with their mileage versus using the actual expenses. Actual expenses, it factors in maybe your maintenance for your tires, your gas, and then any repairs to your vehicle. But people actually assume that they actually pay a lot of gas when actually we're doing a lot of inner city driving. On there, you have a lot of miles. But either with the standard mileage, you're also able to deduct any business parking fees as well as tolls paid. The commission and fees. So definitely for like our Uber and Lyft, they have a lot of fees that they have. And then with Uber and Lyft, they have a summary sheet of their expenses that the company charges, which is helpful for us. So that means the client doesn't have to come and think about all these expenses. We can take it from this sheet. Those commission and fees that are listed there. And then also if it was anything where we paid an individual, they paid an individual less than the $600 requirement. Then we have our insurance. This is not car insurance. This would be business insurance on here. This could be liability insurance for their business, not their vehicle insurance. We have other interest. Maybe they took out a business loan, or it could have been a personal loan that they're using strictly for business. So the interest that they're paying back could go under other interest. Legal and professional services. Maybe they have a bookkeeper or they have an attorney that they use on there for those services. Office expense, that could be related to any supplies or maybe like hairdressers on there if they have, well, actually that's going to go to the rent or lease on there, but anything related to any type of office expense. Rent or lease, it could be vehicle, machinery, or equipment on there. So if they're having to go for travel, they have to rent a vehicle. Machinery or equipment. There's also the rent for office space that allows them, so our hairdressers. There's the repairs and maintenance, and this would be for equipment, again, not for vehicle because we're using the standard mileage. So repairs and maintenance for anything outside of your vehicle expense. Supplies, this could be paper, pens, those type of things. Taxes and licenses. So maybe if a person is paying their sales tax, they would be able to write that off. Also, if they have to have a special type of license, if there may be a truck driver, the 18-wheelers, and they have to get a special license or renew, then that could go under the license. And then for travel and meals, so for 2022, this was also for 2021, they're able to deduct 100% of business meals paid to restaurants. So in the past years, it was 50%. But all we have to worry about is them just giving us the total number, and we input it in TaxSlayer, and TaxSlayer calculates the percentage. So even if when it does the 50%, TaxSlayer takes the full amount that we enter in and will give them 50% of that. Then there is the utilities. This is utilities if they had a separate office location outside of their home, utilities related to that. So no utilities related to their home. And then there's any other expenses that you feel that is not listed above on there. There is a section in TaxSlayer that you can write those out, like we talked about the postage and the shipping. So again, where do we go and input this information in TaxSlayer? So you're going to see that I've highlighted the 1099 NEC. This is where you're going to enter in that form. So you have to take those forms and you have to take that 1099 NEC form and attach it to that profit or loss from the business on there. So when you enter in that 1099 NEC, it's going to ask you if you want to transfer it to a Schedule C. Now, if it's a previous client, you're going to see that Schedule C, and you should see a little drop-down menu, and you should see their business, the type of their business, the category on there. So we do not do any Schedules F form or any form income. So when you select the Schedule C, it carries that form, that 1099 NEC, to the Schedule C. So you have to populate the Schedule C for that 1099 NEC, or it will not calculate any of the self-employment tax. On there you can see where if you have more than one 1099 NEC, you can always add another one. This is like a little hyperlink that you can click on it, and it'll give you another form. And as you enter that 1099 NEC and press continue, it's going to continue to allow you to add it to that Schedule C. Now, somebody could be a landscaper and they could be an accountant. So because those are in two different industries, you could have two separate Schedule Cs in TaxSlayer. So you would need to make sure that you link the correct 1099 NEC to the correct industry. The taxpayer and spouse, they both could be Schedule C filers. So making sure that we have a Schedule C for the taxpayer, it shows you the owner, and then one for the spouse. So making sure that you're carrying the 1099 NEC to the correct form and to the correct individual. So then once you go into that, you connect that 1099 NEC to the Schedule C, pretty much you're filling out this information, basic information about the business on there, questions about the operation of the business. The basic information is if they have like a business name, that they obtain an EIN number, the address. Questions about the operation. Is this their first year doing a Schedule C? Do they have any inventory? Again, did they materially participate? Most pretty much all sole proprietors, they materially participate because they rarely have any additional employees. Or they could be utilizing their family members. Then their income. So we've already entered the income in from the 1099 NEC. If you click on the edit for the income, you should already see the income from the 1099 NEC pre-populated in there. The only other income that you would have to enter is cash income, check income, 1099K income. But 1099 NEC should already be listed. You'll see that our cost of goods, that's out of scope. Those general expenses that we talked about, advertising, insurance, office expenses, all of that, the commission fees, that's under general expenses. So all you have to do is take the amount that's listed on that form and input it in TaxSlayer. We do have a few clients that utilize their own QuickBooks. So sometimes they already have a form that's printed out for us that is given the total annually, and all we have to do is input it in there. Then we have our car and truck expenses. Remember, they're getting just their standard mileage just off the business miles. It will still ask you about commuting. So maybe if they have another job and then the self-employment job, this is their second job. So the commuting could be related to their W-2 income or leaving their home to the office location. And once we put in the number of miles, TaxSlayer is going to calculate the mileage rate for us and give us that expense cost. Other expenses, this is again where you go and add anything that you don't see listed or a good category that fits under general expenses. You can put it on other expenses. Like maybe a person purchased a laptop or a printer, if you want to add that under other expenses. The qualified business income deduction, this is not something that we have to enter in. TaxSlayer will calculate that deduction for us. The expenses for business use of home, that's out of scope. And so when we hit continue, TaxSlayer is going to calculate, take that income, offset it against the expenses, and let us know if that client has a net profit or or if there is a loss. So these are just the sections where I just went through, where it talks about questions about the business. So like the accounting method. On there again, inventory is out of scope. And we already talked about under those general expenses. On there, go to the next one. Those general expenses, on there we've already talked about some of the common ones and which ones were out of scope for us. You're just inputting that annual amount in there. We did the Schedule C, the car and truck expenses. Again, they're getting that standard mileage rate based off the business miles. You see that asterisk right there, right after business miles. Commuting and other, those are just for informational purposes. But again, you'll see commuting miles or miles driven each day from home to the first business location and driven from the last business location back home. And then other would be just any other personal miles. If you have to go out of town, you're using this vehicle for business and personal purposes. Let's see. And so here's a chart that kind of helps you determine what's actually commuting miles on here. So the home, a person could actually have their home office. So if your main office location is home, where you work from home, and maybe you have to go and see a client on there, then that would be considered business miles on there. But for as like a Uber rideshare, Uber Lyft driver, Their home, they don't have a business. They're just waiting for like their assignment. So then it would be their home to their first customer would be commuting. Then, like I said, their last customer back home, that would be commuting for them. And so what is the main focus for business income? We want to teach our tax clients about good record keeping. So if you have a client that comes in and they have a business and they really don't have like any expenses, even if the intake has told them, you can tell them, hey, you need to make sure that you keep records next time, even if it's on a notepad, writing down your income and expenses, just so that helps you to have additional documentation if you were to get audited on there. Because, it does look skeptical if a person, they say they made 10,000 and here they are wanting to write off 8,000. So that means, we could come back and be like, hey, do you have something to show for this? Or is there needed additional documentation? Our backup to help us is we've made them complete this worksheet. But I know just from having some people to complete the worksheet, if I see a significant number in business meals on there. Also knowing that we're coming from a time of COVID and a lot of interaction kind of like decreased, possibly. I would have to also think about the industry, but then I would say that, hey, I don't think a lot of people would have had business meals. So no, we won't accept that number. I don't think that's an accurate number on there if they're completing the worksheet. Now, if they came and they did a QuickBooks, I'm pretty sure, I'm not going to say they're 100%, but they've taken the time and they've used some QuickBooks software. That means they're inputting these receipts and it's populating this for them. So we do have some individuals that are very good about record keeping and categorizing. Once we tell them, hey, you want to make sure you have the documentation together and organized, not for us, but yourself if you were to get audited. And so, yes, good record keeping. It could be bank statements. It could be a receipt book. Again, it could be a notebook, just where they have the detail of the information on there that they can be able to provide on there. I try to discourage a lot of using cash to pay for purchases. Cash is not a detail. And then the receipts that you get, they start to fade. So try to use a credit card, or if they can, maybe obtain a business account if possible on there. So finding ways for them to keep track of their business expenses better. Okay. So then before we're finna get ready to take another break. So once we've entered all of this business income in, we've got their income with their expenses, then it determines again, do they have a net profit or loss? Again, if it's $400 or more, they're going to be subject to self-employment tax. And TaxSlayer has already calculated that for us, so it's not something that we have to worry about. It's just when we print out the forms that you see that amount next to Schedule SE, that is their self-employment tax on there. And if they have self-employment tax, TaxSlayer is also going to calculate the adjustment for it. So these sole proprietors, they're paying for the self-employment tax for the employee and the employer. They're doing both share. So half of that they're getting to deduct from their income as an adjustment, and then the full amount, it gets reported on other taxes. Again, so TaxSlayer will compute both of those, and the adjustment is reflected on the Form 1040 Schedule 1. Okay, I think we got this last poll question before we do a break. It says Daniel has his own business. He received Form 1099 NEC for $13,000 for work he completed as an independent contractor. He also received cash payments that total $2,500 for the other jobs he completed for different individuals. Must David report the cash payments of $2,500 on his return? Yes or no? You all are correct, yes. So all income, it has to be reported unless it is explicitly stated by the IRS that it is exempt from tax.
Question.
Yes.
Earlier, I know you said that we didn't account, I'm trying to find where I wrote it down, but we didn't account for checks or cash sales?
So yes, on the 1099K, so when you get into the Schedule C on there, we've only input in the 1099 NEC. That's the only slot for the form. So when you get in the Schedule C and then you see where it has the income, there will be additional boxes where you can report the cash income, check income, anything that was not reported on the 1099 NEC. You're welcome. Okay, so we're gonna so we finished up talking about our business income. So we're gonna go into our capital gain and loss. And so most of the time we're gonna see this on a form 1099B or 1099S, but the one you'll regularly see is a 1099B. And this is also, we're gonna be working on our scenario 8. So you're gonna also see a 1099B in that scenario as well. So what determines if we have a capital gain or loss? It is the basis or adjusted basis. It's also the holding period, and then as well as the proceeds from the sale. So what is the adjusted basis on there? So the basis could be the original cost of the asset, or the adjusted basis, which includes the original cost plus any increases or decreases to that cost, such as commission fees, depreciation, any casualty losses, insurance reimbursements, or major improvements. As well as brokers must report costs or other bases on the form 1099B unless the securities sold were uncovered securities. So that means typically we're going to get that 1099B with very limited information on there. We'll probably get it with just the proceeds and not the basis, meaning the taxpayer is going to have to gather that information from us. And then the taxpayers must use codes to report if the form 1099B was received and whether or not it showed basis reported to the IRS. So for is our basis, and then we have our holding period. So this asset, the short-term property is held for 1 year or less. Long-term is held for more than 1 year. Long-term capital gains are taxed at a lower rate than short-term gains. So it does depend on a person's income as well as their additional income to determine what rate it is. The rate could be as low as 0%. Again, brokers must report whether the gain or loss is short-term or long-term on the form 1099B. So we do see that listed on that form for us where we can categorize those. Unless the securities were sold, again, they were uncovered securities. And then our proceeds from sale. The form 1099B is going to reflect if it is gross or net proceeds for a stock or mutual fund. And then the form 1099S usually reflects gross proceeds for sale of real estate transactions on there. So that could be, so this second bullet point is typically from maybe the sale of a home on what we will see from those. And then what other evidence do they have in the absence of the above? So sometimes we don't even get a 1099S form for real estate transactions, or maybe I've seen where individuals, they received a home, inherited it, they've had it for some years, and now they're coming to sell it. They don't have a 1099S maybe because it's been split with more than one person on there. So this 1099B, what does that look like on here? And so we may see something very similar to this as long as we see the proceeds from broker exchange transactions are that 1099B, but it may not look exactly like this. But it's going to have that payer's name, so that financial institution or that brokerage financial institution. the broker's EIN number, and the taxpayer's tax number, as well as the taxpayer's name. Now, what we're needing is the description of the property. That could be, like it has an example, the shares are XYZ company, so it could be Apple, the date acquired, as well as the date sold. That's going to tell us if it is short-term or long-term. But again, on most of these forms, it already has those stock or mutual funds. It already has them under a short-term category for us and then a long-term category. It'll still have the date acquired or date sold under those short-term or long-term. Then it's also going to have the proceeds, and then it's going to have the cost or other basis. That's all we have to worry about entering in TaxSlayer, because TaxSlayer is going to calculate the gain or loss for us on there. And if a person has multiple 1099-Bs, all we do is we take the subtotal for the short term and the total for the long term. You will not have to enter in every single transaction listed that they have on there. So we will summarize those transactions into TaxSlayer and then put those into the system. But that is the information that we enter in. If there's anything else, we can put that into TaxSlayer, so you'll see that there is a short-term or long-term. It'll also let you know if if the basis was reported to the IRS. We need to know that as well. But again, if you get multiple sheets, like if someone is from, Merrill Lynch, Charles Schwab, JP Morgan Chase, any of those brokerage accounts, and typically they're coming with a thick packet of paper. We're going to just summarize all of those transactions, so don't feel overwhelmed. We have typically in the summertime, people will come in with shoe boxes, briefcases, backpacks, just with all of their stuff, and maybe come down to it after you see it. Maybe there's just only a few sheets of paper. I also see people that like to carry, when they come to the tax office, maybe 7 years worth of tax returns. I don't know why we have to go back that far, but they just like to keep all of their information with them. So if you see it, that means I've seen it, and I'm going to go through it first before I give it to you. So I'm not going to make you have to go through all of those sheets of paper. Then we have the 1099-S. So this is, again, from the sale of real estate. Then it's going to list the filer's name. So it could be maybe mortgage title company, their 10, then the taxpayer's information, the date of closing, those gross proceeds, and then the address. From there, we can then determine were there any additional fees, maybe what was the basis. Then we have the sales price, but is there any additional fees? Maybe like what is the realtors, what's their commission to deduct from there? Were there any additional property taxes that had to be paid from those gross proceeds on there? So we're going to take that the gross proceeds minus the basis, and then minus any additional expenses, and that becomes the amount that they have to report as income. So we looked at those forms at 1099-B, but you may get a form like this. So typically from the brokerage account, they're going to have it section off like this in the summary, where you're going to see the 1099 DIV, the 1099 miscellaneous, the 1099 interest, and then you're going to see the summary on here. So they're going to have all of those categorized on this one sheet of paper for you. And then from the summary, you're going to flip to another sheet of paper, and then you're going to see the breakdown. And this right here is actually coming from our scenario 8 that we're going to work on soon before we leave today. And you're going to see that it has what I have highlighted. It does show short-term transactions for which the basis is reported. So there's 3 options for short-term. It'll be basis is reported to the IRS, basis is not reported, and basis, I believe it's basis is unknown. The same thing for long-term. It's going to be basis is not reported, basis is reported, unknown. And you can see for short-term, it says it is reported, and for long-term, is not reported. So there is a drop-down where we select is the basis reported to the IRS. And so when we get into TaxSlayer, all we're entering in for the description, we can enter the Iowa common stock. We're going to enter in date acquired, date sold, and we're going to enter in the cost basis as well as the proceeds. TaxSlayer is going to calculate the gain or loss for us. If we saw that maybe they had a lot of short-term transactions for this Iowa common stock and it was on different days, all we're going to do is take the subtotal and put it, we're still going to do the Iowa common stock and take the subtotal on there for the short term. It could be maybe multiple descriptions of stock on there. Stock or mutual fund, they're all listed under short term for which the basis is reported. So all I'm going to do is I'm going to take whatever their brokerage account is. If it's Charles Schwab, I can put Schwab and then I can put short term. And then I'm going to go and categorize, get the total for all of those short-term transactions. Now, if I see short-term transactions, basis is reported and basis not reported, then I'm going to have two subtotals for the basis and then for the where the basis is not reported. So just for making it easier, because the tax client, they're going to have this as their record. And then only if there is maybe a wash sale that was disallowed, we may have to put that in as an adjustment. But right now there's nothing on this one, so we don't have to worry about that. So we're just putting in proceeds and cost basis and let TaxSlayer calculate the gain or loss for us. And this is the same thing for the long term. It's going to calculate that for us. So where do we go and enter this in TaxSlayer? Again, this is still all under the federal income section. We're going to find where it has the Schedule D capital gains. And you're going to see it's going to have a drop down. It's going to have capital gain and loss items, additional capital gains distributions, other capital gains data, sale of main home worksheet, PDF attachments. We want to go to that first one, the capital gain and loss items. On there. Down below, you're going to see this is if a person had a carryover loss. So reason why we would need a person's prior year tax return if they tell us they had a carryover loss, we would need to have that information to make sure we input it correctly. But the good thing, if they are a prior client and they've already been to North Dallas Share Ministry, we prepared their 2021, it's already going to pull it into their 2022 tax return. So we click on Begin for the capital gain and loss items. And then it's going to have us to input this information in. You're going to put in who the form belongs to, the taxpayer, spouse, or both. Description of property, that's where you can put that Iowa stock. Or again, you could put Charles Schwab short term. You're going to put date acquired. Select that month, date, and year. Again, if there are multiple transactions on there, so we're going to have multiple date acquired dates. We're going to select that little bitty box right above it where it has alternate option. We're going to select that, and we're going to select, it should say various short term. So that means we have multiple different dates. And then date sold. We don't have that option for the alternate option, but on the date on here, typically I select the last date listed on one of those forms. So if it's December the 13th, the last piece of stock or mutual fund that was sold, that's reflected, I will put that in on the date sold. Again, we're going to put in the sales price on here. And then we have to select the cost basis. Again, was the cost basis reported to the IRS, not reported, or did they not receive Form 1099-B? And you'll see date acquired. It does say various short-term, various long-term, or inherited long-term. So if someone does inherit something from a taxpayer, it automatically defaults to long-term on there. So we input that information in. And then it's also, we put also the cost basis that's listed on the form. We do not, in this box, we do not put the gain or loss. Again, TaxSlayer is going to calculate that for us. Down below, we put an amount if there's any adjustments, and most of the time you may see a wash sale, so then you will click the one that has a W on it. There are times where maybe a person is selling their main home. So a taxpayer can exclude up to $250,000 of their gain if they're meeting the two tests. So that means if that was their main home out of the past, out of the 5-year period, that was their main home for the last, or for 2 years, and then they lived in it out of 2 of the 5 years on there. So you'll see for the test during the 5-year period ending on the date the taxpayer sold or exchanged their home, they owned it for 2 years or more, which is the ownership requirement, and lived in it as their main home for 2 years or more. So again, this is something beneficial. They're able to exclude up to $250 income of the gain of their income. If it's a married filing joint, they can exclude up to $500 of the gain. So this is very good for those people in California coming to Texas that were selling their home. They're not able to report it. But we also have that option too. Again, the $250 up to $500 if you meet the qualifications. So where to put the sale of the home? This is on the 4012 page D32 and D33. It's going to ask you what was the date they actually purchased the home, what was their original purchase price, the date of the sale, the sales price, and then the information to make sure they qualify, how many days in the last 5 years was the home their main home, and how many days in the last 5 years that they own the home. The same for the spouse. And if this was the first time homebuyer credit that they got the home in maybe 2008, they're also going to have to pay back this credit on the tax return. If they did not do the first time homebuyer, are they able to qualify for the maximum exclusion? So that means the 250 or the 500 on there. If their gain is more than that, then anything over the 250, they're going to have to report it as income and pay tax on it. There's also the adjustments for the sale of the main home, where again, it could be anything related to the property taxes, the realtor fees that they can put on their related, like selling expenses, that is going to reduce the gain of the sale. So if a person sells their home and they had a loss, they're not able to deduct the loss of the sale on their tax return. So it's just provisions related to the gain. Okay, we have another poll question. It says Kevin paid his broker a $75 fee on the sale of his stock. His Form 1099-B shows $925, and the box next to net proceeds is checked. What is the amount Kevin reports as his sales price? And remember, we talked about you don't make modifications to what's listed on the tax form. You enter it, what's on that form, you enter into TaxSlayer. So what do y'all think was going to be reported as his sales price? Say it again. I think I heard it. So here, because we're not making any changes, even though it says the net proceeds, that's reflected on the 1099B, so it's still going to show the 925. We don't make adjustments to it. Okay, before we go into retirement income, are there any questions? Okay, so retirement income, this can include Social Security benefits as well as benefits from annuities, retirement or profit sharing plans, insurance contracts, IRAs, etc. The retirement income, it may be fully or partially taxable. Okay. So what form is retirement income on? It is on a 1099-R. So again, this is retirement, 401k, pension annuities, IRAs. So we're going to have the payer's information, their TIN, the taxpayer spouse information, as well as box 1, we have the gross distribution. Box 2A could be different than box 1. This could be the taxable amount. Also, box 2A could be blank or it could have 0. So we want to pay attention to what's actually in box 2A. If it is just blank, that means we have to determine what the taxable amount is. 2B, it could have it checked off taxable amount not determined or total distribution. Hardly see stuff in box 3. Box 4, federal income tax withheld. Most of the time there is up to the 20% of federal taxes withheld for income, depending on definitely if it's an early distribution. Box 5 will show employee contributions. On there, did someone contribute to their retirement or their pension account? What is that amount? Box 7 will tell us the distribution code. So is this, how is an individual receiving it? We talked about the 59.5. Have they met that 59.5 requirement? If they haven't, are there any other exceptions that apply? If they have 59.5, that means it's a normal distribution. Are there any other type of codes like disability codes? So we're going to go through those distribution codes. Also, still in box 7, it shows us if this is a IRA, SEP, or simple plan on there. And then it'll also have 9B, total employee contributions. So that's going to help us if number 2A, box 2A is blank, then we have to find out what that amount is. So we actually have quite a few of these that come into our office location. I will say most of the time we have in box 7, it's a code 7, which means it is a normal distribution. So it's just being reported as income normally and they're not subject to any penalty. So all TaxSlayer is doing once you enter in the information, it's going to take the amount in box 1 as well as box 2A, and it's going to apply whatever tax or treatment to it based on box 7, the distribution code. So partially taxable pension annuities using the simplified method when the 1099-R box 2 is blank. So the simplified method is going to calculate the tax-free portion of each pension or annuity payment. The simplified method worksheet calculates the taxpayer's cost basis for each monthly payment. The number of the monthly payments is based on the taxpayer's age and the spouse's age if it is a joint survivor annuity that is selected on the annuity start date. So all of this information, we have a scenario for this. This is going to be based on the interview notes, and we're going to get information that we need from the 1099-R. So we're taking, if a person says if the 2A is blank, then we have to ask them when did they first start receiving their annuity. So what is the month, date, and year, and how old were they at the time they first started to receive the annuity. We also need to know, we'll have the 1099-R form, and what is in box 9B. What is their cost to the plan? What's their contributions on there? And it's going to help us calculate of the gross distribution, what is the taxable portion to them, and then what is the tax-free portion. And then box 2 is going to show the taxable portion. So disability pension income, this is still with the 1099-R. Generally, taxpayers who retire on disability must include all of their disability payments in income. Disability payments are treated as wages until the taxpayer reaches the minimum retirement age, and this is set by the employer. So after the taxpayer reaches the minimum retirement age, then the disability payments are treated as regular pension income. So this 1099-R, we see in box 7, that's the distribution code. If there is a code 3 on their, code 3 says they received it for a disability. If they haven't reached the 59 and a half, or maybe there's another age limit set through their employer, then this 1099-R with box code 3, we're going to select the button, we'll show it. It's going to treat it as W-2 income. So going to the screen on here. Again, all of this is still under the federal income. And we see at the top it has, under the IRA pension distributions, add or edit a 1099-R. And then when we go to the next one, we're going to see that 1099-R screen. We're going to put in who the form belongs to, the payer's information. So this is going back to the box 2A is blank. You're going to see when we fill in the amount in box 1, it's going to automatically populate it in box 2. But we have to go and correct that. So right under this box that says does not carry to form 8880, we need to click that little hyperlink. Do you need to calculate your taxable amount? Click here for options. So you can go ahead and fill out the 1099-R and then click that hyperlink. And then when you click the hyperlink, we're going to go to the next slide real quick. It's going to be then where you're going to have the screen. You can go to the next one. And it's going to say the simplified method worksheet. And then we're going to hit begin on there. And then within this simplified method worksheet, we're going to put in the plan cost at the annuity start date. So that was that box 9B on the 1099-R. The starting date of annuity. So this is when did they first started receiving their retirement. So again, that's that month, date, and year. When did they first start receiving it? We have to make sure we check this little box if it is a joint or survivor annuity. So if it's a married filing joint return on there. And then we go then and ask for the age of recipient at start date. So when they received their first payment, how old was the taxpayer? Again, if it's a joint survivor, the taxpayer and spouse. Or again, if it's a spouse plan, how old was the spouse? Again, if it's a joint survivor, the spouse and taxpayer. And then the number of months paid for that tax year. So if they actually started their retirement plan in 2020 and we're doing their 2022, then we know it would be 12 months because they actually started it some years ago. And then amounts previously covered, we can enter that amount if we know what it is, or we can leave that blank. And so what's going to happen is it's going to calculate this information. When we hit continue, it's going to let us know what is the taxable amount of that 1099-R. Now I'm going to go back just a few slides. And just so we can see on slide 157, on here when I was talking about that distribution code, box 7, distribution code 3. When we go and we check that that's disability, we see here that we click here to report on form 1040 line 1. That means that person is receiving their pension because of a disability, and they have not reached the retirement age of 59 and a half or the age set by their employer. So this treats their retirement as wages, which means, again, they could qualify for the earned income credit, some additional credits on there. Once they reach the retirement age, then it's going to be treated like a regular pension. And it should convert that code from a 3 to a 7. Okay. Then we're going to talk about the Roth. So you don't include in your gross income qualified distributions or distributions that are a return of your regular contributions from Roth IRAs. So with the Roth, this is after-tax a plan that is used with after-tax funds. So distributions from a Roth IRA, they are tax-free and may be included from income if the following requirements are met. The distribution is made after the 5-year period beginning on the first day of the first taxable year for which a contribution was made. The distribution is made on or after the age of 59 and a half, or because the taxpayer was disabled, or made to a beneficiary or to an estate, or to pay certain qualified first-time home buyer amounts up to a $10,000 lifetime limit. So we have the Roth IRA, and then we have the traditional IRA. The traditional allows for a tax return adjustment, if the taxpayer and spouse qualify. So for most of our clients, they will qualify because it is based upon their income and if they have a retirement plan at work. So with our VITA program, we service most clients that have income under $60,000, so they would qualify to contribute to a traditional and deduct their contribution on their tax return. With the Roth on there, you're not deducting their contribution, but that means the money that they put in the Roth account, because it's already been taxed, the interest that they earn on the money in the Roth account is going to be tax-free. So meeting those qualifications, when they pull it out, all that's going to be reflected on the tax return is just for informational purposes and not included in gross income. Then we have the qualified charitable distributions. I've seen this is typically for most of our retired individuals where they're taking money from their pension retirement account and they're donating it to a charity. So this qualified charitable distribution is not included in income. It is not allowed as a charitable deduction. It counts towards the taxpayer's minimum required distribution. So we talked about penalty. So there's a penalty to pull from your retirement before you reach 59 and a half. There's also a penalty if you let money sit in your retirement and you do not pull from it at the designated time. And I believe now the age is 70 that they have to pull from their retirement. And so they typically get a letter from the financial institution. And then it must be a direct distribution from the trustee to the qualified charitable organization. So that means the taxpayer would not pull it directly out of their account. They would go have their trustee. So if that's a Merrill Lynch, they're going to have it and send it to their organization, their nonprofit organization. The amount of the qualified charitable distribution should be deducted from the gross distribution and the result entered in box 2A on the form 1099 screen. We also have here during COVID, we talked about in 2020. So a lot of people, there were individuals that maybe lost their job or took a pay cut. So if they needed some additional funds to help take care of their normal day-to-day expenses, if they had a retirement or pension account that they could have taken advantage of, they could have pulled it out in 2020. So I could have, if I needed to, pull money out of my pension for 2020. And if it was COVID related, I'm not 59 and a half, I would have been any other year, I would have been paying a 10% penalty. But for COVID, the penalty would be waived. So, but that doesn't mean because this is pre-tax money, I still have to report my 401k funds that I receive. I still have to report it as income. So the IRS came up with two options. You can either report all that you receive from your distribution in 2020. You can report it on the 2020 tax return, or you can spread it over 3 years. So that means you're reporting a third in 2020, 2021, and 2022. We did have a few individuals that took advantage of this option, or we encouraged them based upon the amount listed on their 1099-R. So how we would enter this in is if maybe there's a client and they bring in their 2020 return, or they let us know, and we have to go in TaxSlayer and populate the form 8915F, or it is a past year client. So that's the good thing about a past year client. Their information just rolls over from year after year, and it makes it easier for us to enter in their information. So someone may come in for 2022, we don't have a 1099-R form, but you may see some income, retirement income, and it could be because they have to report their last third of income received in 2020 tax year. And so if you get something like this or something like this pops up, typically what I would tell you to do is go ahead and enter in all the other information like the W-2, because this is something that is not normal. This is not something that happens like year after year. So when we get to this section, I would be like, okay, we can actually go and walk through inputting this information in or confirming that the information is entered in correctly. They also had the option of doing recontributions. So that means still contributing to their retirement account to reduce the distribution amount that they received or had to report as income. But again, this will be something that you'll get more direction from your site coordinator if you have it, and we can direct you more onto how to input it in the system. So this is that form 8915F, where it's going to ask you to put in either if it's a non-IRA, so pension retirement, and how it actually gets split up to report that third for the year. And again, your site coordinator can assist you. So we talked about on this 1099-R, we talked about those distribution codes in box 7, because there are a lot of different codes that could be in box 7. And so what I've highlighted is the common ones that we see. So you'll see box 7, if it has a code 1, that means it is an early distribution. The financial institution was not aware. And so if we don't find any exception to the penalty, that means the taxpayer and her spouse will have to pay the 10% penalty based upon that distribution amount. Box 2 is still, number 2 for box 7, it's an early distribution, but there was some type of exception that applies. I'm not worried about what the exception is. When I see box 7 with a code 2, I'm going to input it in. That means that they will not be hit with the 10% penalty on their tax return. We've already talked about code 3 with the disability, that if they're still under the retirement age, is going to go to 1040 line 1 and be treated as wages. And so the taxpayer may be able to qualify for the earned income credit. Or it should eventually convert to code 7 once they reach the retirement age. Box number 4 for box 7 means it states death. That means a person is receiving it on behalf of another individual that has passed away. So if they were the beneficiary, the spouse, that means the person, the original owner of that 401k has passed, and so they've taken it over. They're now receiving the distribution. And then we have box 7, code 7. This is a normal distribution. So those individuals that have reached 59 and a half, that all they're doing is the amount in box 2A, that taxable amount, they're just reporting that as income. There's no penalties that they're subject to. And then there is some alpha codes. And so the one that I've highlighted, it is the direct rollover of distribution and direct payment. So a code G, this is a rollover. So maybe one person is leaving one job and going to the next, and they're moving their retirement plan over. They would have a code G. This is a rollover. So on the tax return, there's no income being only just informational income being reported, but no income being taxed on there because the taxpayer did not receive or touch any of the income. So you can do a 401k rollover to another 401k and have a code G where you're not including this as tax. You can have a 401k to a traditional, but a pension, 401k, or a traditional rollover to a Roth requires that you do have to report the distribution as income. No penalty, but you'll have to report it as income because there's different tax treatment. A 401k, pension, traditional, they're pre-tax contributions. A Roth is after tax. And I always advise that if you're moving funds over, let the trustees of the account communicate with one another on there. So that code G, we hardly ever see any other codes, so we're going to bypass those. And it's going to take us to our next poll question. So Andrew changed jobs and received Form 1099-R from his previous employer. The gross distribution amount in box 1 is $11,200. Andrew deposited the entire $11,200 into his IRA within 60 days of receiving the check, a rollover. Which of the following statements is true? Is the entire distribution includable as income, excludable as income? The distribution is eligible for a 10-year tax option. The distribution is eligible to be taxed at a special rate. So he did do a rollover. He actually did it himself. So what do you guys think that he actually rolled it over? So he did not receive the income himself to use it for personal.
Non-taxable?
B, yes. So that is correct. He can exclude the entire distribution because it was rolled over into an IRA. And so with him, by him receiving the actual check himself, there is a 60-day window to get the funds from one institution to the next. But that's why I tell individuals, don't touch the money yourself. Actually have the trustees of the account, which is the financial institution. They will, you can open up another IRA or have another 401k with your job, and they move it over for you. But because Andrew got a check, he had a 60-day window to move those funds over. Okay, this next question. Dottie worked for the local tire plant for 32 years. She retired in June and receives a monthly pension of $1,679. She received 6 months for July through December. Dottie never contributed to the pension plan. Her employer made all of the contributions. How much of her pension is taxable? So she never put anything in the plan. It was her employer. So she received 6 months of the $1,679. How much do you think of her pension is going to be taxable to her? What do you guys think? She didn't make any contributions.
All of
Okay. And all of it, what is that number that you come up with? So it is the 10,000, the 74. Okay, so our next item we're talking about is our unemployment. So this unemployment compensation generally includes any amount received under an unemployment compensation law of the U.S. or of a state in the U.S. In most cases, unemployment compensation is taxable. So again, in 2020, we had provisions where the first $10,200 for taxpayer and spouse was exempt from unemployment. But other than that, all other years for 2021, 2022, if a person receives unemployment, again, it is taxable income to them. It is not considered earned income because they did not work for it. And here's what the form will look like once they receive it, a 1099-G. You're going to see that they're going to have that whatever commission. So for Texas, we have the Texas Workforce Commission. Then the recipient, the taxpayer, or spouse name, and the amount of unemployment compensation that they receive. If they do not have this form, they can go online to their unemployment portal, and we can get this amount and pull it and enter it into the software based on that. Also, for box 4, federal income tax withheld, they have the option, the taxpayer spouse will have the option if they want federal taxes withheld or not. So there is, if they decide to opt in and have federal taxes withheld, that is just a standard 10% for each payment they receive. If they don't, then it's just 0. So it's 10% or 0. And we do recommend for individuals to have federal taxes withheld on there because you don't want to get hit with an amount due when you get ready to file your tax return. So again, we will probably have the 1099-G, or again, we can actually look at this form on their unemployment portal. Then we also have some Social Security benefits. So this is also called the Old Age Survivor and Disability Insurance Benefits. It includes monthly retirement survivor disability benefits. They do not include SSI, supplemental security income. If a person says they receive SSI, that is not taxable at all. If their only income is SSI, they are not required to file a tax return unless they meet some qualifications on where they should file a tax return. So certain government employees who receive a pension from work are not covered by Social Security. That's also our teachers. So if they're part of the TRS, the Teacher Retirement System, they have their own pension retirement and they won't receive Social Security benefits unless they worked somewhere else. Some portion of the Social Security benefits received, it may be taxable. Generally, if Social Security benefits are the only source of income, then the benefits are not taxable. So if a person has Social Security benefits, they're pulling from maybe a pension from work, they have interest and dividends. If it is over a certain threshold, then yes, some of their Social Security benefits will be included in income, and it can be up to 85% on there. So one thing that I like about the Social Security form that we're going to see, you can go to the next, is that on the back of it, it has an instruction worksheet, and it will break down the filing statuses for single, married, filing jointly. I think they just use those two. And it'll have you to take 1/2 of your Social Security benefits, add it with all your other sources of income, and if it exceeds a certain amount, then yes, some of their Social Security benefits are taxable. And again, up to 85% of that person's Social Security benefits can be taxable. You'll see this is a 2019 form, just because it's so hard trying to find current year tax forms. But this is the form that an individual will receive that we need if they have other sources of income that they have to bring in. unless they have created an account on the Social Security Administration website, or they go to the office to get a printout. But what we're taking from here is the amount in box 5. That is their net benefits received for 2019. Also, when we talked about earlier about Social Security card, this is a form that I would receive in lieu of a person not having their Social Security card or a picture of it. We would take their social out of box 2, the beneficiary Social Security number, because it's also going to have in box 7 their full name and address listed as well on there. Sometimes the amount in box 3 is going to have a description. Somebody may have been working for a few years to receive their Social Security disability payments, so they could receive a lump sum. And depending on what that lump sum amount is, maybe your site coordinator may go back, if they are a returning client, to maybe, if they owe, maybe see how they can have some of that lump sum be taxed at a prior year tax rate on there. But this is a form that they would bring in for their Social Security benefits. Again, we can take a form, they can go to their the Social Security Administration account if they have created one, or they can also go and make an appointment at the Social Security office to get a printout of this. And again, box 2 will have their Social Security number, so we will take this form in lieu of a Social Security card. So where do we enter in Social Security benefits? So when we go and look at the IRA pension distributions under income, and we click on the IRA pensions and distributions, you're going to see the third option, Social Security benefits, and we're going to select that option. And then it will allow us to enter in taxpayer and our spouse Social Security. You'll see the first box, it says box 5 for the taxpayer. If there were any federal taxes withheld from the taxpayer, as well as taxpayer Medicare premiums. So there are very few clients that we have that will have federal taxes withheld from their Social Security benefits. So what other income do we have that does not have its own line on the Form 1040? And we see this on the Schedule 1. We talked about prizes and rewards, prizes and awards. So this is going to be on a Form 1099 miscellaneous box 3. So those are those people that are on Jeopardy, Wheel of Fortune, those type of game shows. Or maybe it's one of those, surveys or something you got through your email. Or it could be some people do like those little studies, those maybe sleep study or trial studies that they are compensated for. We also have gambling winnings, including lotteries and raffles. If it's over a certain threshold, then they will receive a form, and it's a Form W2G on there. So that gets inputted into TaxSlayer. There is a place where we can actually add those forms. You'll see the 1099 miscellaneous form, or you'll see Form W2G gambling winnings. Jury duty pay. I don't know who actually opts in to actually receive their jury duty as pay. I think most people probably decide to give it back, or I think it goes to like the detention center, youth detention center. We did talk about a little bit the non-business credit card debt cancellation. That's that Form 1099-C or 1099-A. So we talked about that car, stop making payments on the car and it gets repossessed. And if they have to resell it and it's for a value less than, then that cancellation of debt for that credit card or car or what have you, that they have forgiven for you, that does become income to you. So typically this transpires over a few years. Once you stop receiving any kind of communication from that car or credit card, then all of a sudden pop up in your mail, you get a 1099-C form. And so that's that cancellation of debt. Again, you may be able to reduce or exclude some of it from your income. So that'll be requiring another form that we would have to complete. And then the last one is the health savings accounts where distributions are not used for medical purposes. We talked about that HSA that you can use for medical, dental purposes. This is pre-tax funds on there, and as long as, again, it's used for medical, dental, vision purposes, you do not have to report the distributions as income on there, and that's on a Form 1099-SA. If it gets used for any other purposes, it becomes income, and you also have to pay a penalty. So on here in TaxSlayer, we have where our less common income is. So we'll see on the income, after we see all of our common types, we'll see less common. Then we'll see at the top where we have other income not reported elsewhere, if we have to find a slot to put something there. Gambling winnings, you'll see that W2G. Remember, right below gambling winnings, we did the other compensation that takes us to the scholarship and grants. We see the cancellation of debt, that 1099-C, where we add that to determine if we can exclude some of that debt from income. It will be the Form 982, where you have to list out your assets and liabilities as of the date of cancellation. So you have to determine if you were solvent or insolvent, if your assets were greater than your liabilities or your liabilities greater than your assets. And this is the solvency worksheet that we have in our 4012 to determine if we can reduce some of that cancellation of debt income. And this is as of the date of cancellation, which is listed on that Form 1099-C.